Everybody, Rob Bruner at Valtenson Bruner Financial Planning. Today we're going to talk about taxes, and we're going to go over some of the basic tax documents, how a tax return works, and then some tax savings ideas. So we're going to get right into it. Disclosure, if you're watching this video, please know that we're not talking about your specific situation. So if we're talking about a specific strategy, we want to have that individual discussion with you about your individual situation. So we're going to talk about income, deductions, taxable income, some of the tax forms, how the tax calculation works, and reducing your taxes paid. So first of all, we all kind of know net income, gross income. Gross income is the total amount you're paid before any deductions. And then net income, or sometimes what we call the take-home pay, is what hits your bank account after all those deductions. There are some required payroll deductions. So by law, employers have to take some taxes out, federal and state taxes. Sometimes there's even city and local taxes. In addition to that, there's what they call the FICA, the Social Security tax, and the Medicare tax. Social Security is known as FICA because that's an abbreviation of Federal Insurance Contribution Act. And under those deductions, you have the employer portion, the 6.2 for Social Security and the 1.45 for Medicare. And then you also have the employee deduction, 6.2 and 1.45. So the contribution for Social Security and Medicare is kind of split between the employer and the employee. Now, in 2022, there is a cap on how much is taxed for the Social Security. That's $147,000, but there is no cap on the Medicare tax. In addition, there is a 0.9% additional tax for those making over $200,000 or $250,000. And what does Social Security do? Well, Social Security provides retirement benefits, benefits for dependent retired workers, and benefits for disabled workers, or survivor benefits for spouses. So it's not just a retirement benefit, it's kind of a social insurance benefit for disability, for early death, for survivors, and for retirement. And then Medicare, I think we all kind of have an idea of what Medicare is, but until you're 65, you don't really probably have a lot of information about the system or even need to know about it. But it's basically the health insurance program for those 65 plus. And Medicare is paid for as you work, and then when you retire, there is a monthly payment along with adding in a supplement or drug plan to that too. The other voluntary payroll deductions are things like health insurance, retirement savings, union dues, charitable contributions, or other employee benefits. Some of the most common tax documents are your W-2. That's what you get at the end of the year from your employer. 1099s are another kind of group, interest or retirement benefits. There's also what's called the consolidated 1099 and retirement savings. You also would get potential tax documents from charitable contributions or employee benefits or health insurance. So the W-2 is really the most common form that reflects your wages through the year and what was withheld. It's an annual report you get usually in beginning of February, sometimes a little bit earlier, from your employer. If you withheld too much, you get a large refund. If you didn't withhold enough, you're going to owe tax. So it kind of comes out through your tax return whether you did enough withholding there. And just a sample, this is what it looks like in general. We've got box 1, which is your wages and tips and compensation after deducting some of these things like a retirement plan contribution. And then the wages that are taxed for Social Security and the wages that are taxed for Medicare, how much they withheld for federal income tax, how much they withheld for Social Security and Medicare, and then down here usually on the bottom is state tax withholding. 1099 interest, I guess I don't have any numbers on here, but in this box would essentially be the interest you earn from a bank account, which happily they now are paying some interest on those bank accounts or money markets, so you'd see that interest there. And then 1099-R really is a retirement distribution. So this can be pensions, 401k distribution, IRA distribution. It's going to show gross amount, taxable amount. This is the important spot here where it's showing the distribution code. Usually it's a 7, so it shows a normal distribution at age 59.5 or older. And then it's also going to show your tax withholding, the federal and the state down here. This one gets a little busy. It's a consolidated 1099, so this would be like from a brokerage account. It's going to show your dividends up towards the top, and then really down along the bottom showing the net return from anything that was bought and sold during the year. So then we look at a 2021 tax return, and we expect the 22 return to look pretty similar in format to this. We're looking at it and seeing the, whoops, I went a little too far, the total of the wages and tips from both spouses, the dividends, or the next line down was the interest, the dividends that were paid out, the IRA distribution, the pensions and annuities, Social Security, and then capital gains. Now, a couple things I'll point out here. From a dividend standpoint, qualified dividends are dividends from companies that are based in the U.S., and so they have a kind of preferred status as far as taxation goes. So they have a little bit different tax structure than a ordinary dividend. And so you'll see kind of the breakdown, the ordinary dividends versus the qualified dividends. Then the other line that changes a little bit is this person actually received $18,000 from Social Security, but they're only taxed on $15,300 of that. So there is a little bit of a break on Social Security tax. If you have other income, your Social Security is going to be mostly taxable. Basically about 85% of it's going to be taxable. If you have no other income, then you're likely going to be in a situation where Social Security is not going to be taxed. So your Social Security taxation depends on your other income and how high that is. So then we go down here, we added all that up, 188. We have a standard deduction for this person, and then this new little thing here where we get some charity deduction even though they're doing a standard deduction. And we're going to talk about the difference between standard deduction and itemized deduction here in a little bit. So we added it up, we subtracted the deduction, and we get $161,550 for taxable income. And then the software does the tax calculation, and we'll show how that kind of rolls in a future slide here. But the tax on that is $26,618. This person withheld from W-2 wages $10,000. They withheld from 1099 distributions, so IRAs and stuff like that, $18,000, so they withheld $28,000. Down here is usually where we get into the tax credits. So this particular person has a child tax credit of $2,000. So we add up what they paid in, what they have for credits is $30,000. Well, they only owed $26,618. So in this case, the $30,000 minus the $26,618 is their refund amount. So that's the amount they get refunded. Now, I was talking before about standard deduction versus itemized. For a standard deduction for single filers, $12,950, married is $25,900, and head of household is $19,400. There are some additions for those 65 plus that add a little bit more to that standard deduction. So then when we look at Schedule A on your tax return is where we add up your itemized deductions. So for most people, it's these two sections here, these three sections here. Occasionally, if you have a year of high medical expenses, you can get kind of a partial deduction of those medical expenses, but they do have to exceed 7.5% of income. So for most people, they don't hit that threshold and then are able to deduct the medical above that. But for some people in a high medical cost year, that can apply. So in this case, they had a small deduction, so they had medical expenses of $15,000 and were able to deduct $855 of that. Then we get into the taxes you paid. So we get into state income taxes, real estate taxes, personal property taxes. We add all those up and we get $21,500. Well, you may have heard in the past couple years they had what they call the SALT limitation, S-A-L-T. That stands for state and local tax. And so with the new tax law that came out, they said a couple years ago, they said, well, you are limited to 10,000. So this 21 is not 21.5, it's 10,000. So we got 855, we got 10,000. This person also had $10,000 of mortgage interest, so that gets added in, and they had 4,000 of charity. Well, look what happened. That added up, that 24,855 did not exceed the standard deduction. So in this person's case, they are getting no benefit from mortgage interest deduction. They are getting no benefit from charitable deduction, except for that little $600 provision that came out during COVID, where you can deduct 600 married filing joint or 300 single, even if you're not itemizing. So in this case, you hear a lot about mortgage interest deductibility, but if you're not itemizing, it's not helping you. Schedule B just shows a summary of dividends and interest. And so this is how we get into the scenario of how the taxes are actually calculated. When we look at it and say, well, the tax return we were looking at was $161,000 of taxable income. So they had $188,000, but they had a standard deduction. So whatever your standard deduction amount is, or your itemized deduction amount, you're paying 0% tax on that number. And then we get into the taxable income number. So now when we get into taxable income, the first 20, and this is married filing joint, there's different numbers for single. I'm just looking at married filing joint for this example. The first $20,550 is taxed at 10%. The next, call it $63,000, is taxed at 12%. Then between 83 and 178 is 22, and so on down the line. So your effective tax rate, your average tax rate, isn't your high rate. So in that person's case, if their taxable income was 161, well, they're not paying 22% on the whole 161. They're paying 0% on a piece of it. They're paying 10% on the 20,550. They're paying 12% on the 63. And then between the 83 and the 161 that they were at, they are paying 22% on that portion. So your actual rate is basically a blended average rate of all those numbers. And there's different thresholds for married filing separately, which most people don't do married filing separately because it doesn't make sense. It only makes sense in special cases. And then taxable income, head of household, is a little bit different brackets than single. And then we get into child tax credits. So the question is, does having a baby affect my taxes? Well, yep, it does. Kids, and I always preface that by saying, your kid is going to cost way more than any tax credit you're going to get by having them. Believe me, I got 3 kids, one in college, one in high school, one in middle school, and there's money flying out the doors for those kids all the time, which I love dearly, but they're not cheap. So you do get a little break. You get a child tax credit. Depending on income, it can be phased out. So after 440 of adjusted gross income, you don't get the credit anymore of married filing joint and 240 for single. Now the criteria is 16 or younger, provide half the support, lived with you for half the year, claimed as a dependent and U.S. citizen. So there's a little bit of a criteria there they got to meet. There also are child and dependent care. So if you're paying for daycare for a younger kid, there can be some credits there that can help offset some of the cost of having a kid. So then how do we reduce taxes? So if you have a 401k plan at work, saving pre-tax in that 401k. If you are self-employed, there is something called an individual K that we have set up for some of our clients. And so you can save money in taxes by putting money in pre-tax to that 401k. It reduces your taxable income. Now there's also something called a Roth 401k. And it could be to your advantage if you're in a lower tax bracket to put money in the Roth 401k while you're in that lower bracket. And then as your income increases, to put money in the pre-tax later on. That's one of those questions we answer when we talk to you individually and look at where you're putting the money and how it's being allocated from a retirement savings standpoint. Deferral limits, $20,500 if you're under 50, age 50 plus in 2022, then you can put in $27,000. So those are the dollar limits you can put in those 401k plans. And then when it gets into deductibility of IRAs, I'm not going to cover this in super detail, but basically saying there are income limitations that allow you to deduct IRA contributions. Now, this isn't 401k, this isn't employer plans, this is your individual personal IRAs. And so depending on your income level, you're either able to deduct it or not. The max amount you can put in is $6,000 under 50 or $7,000 age 50 plus. So you'll see here, a single taxpayer, if they make less than $68,000, it's fully deductible. If they make over 78, it's not deductible, and in between, it's partially deductible. And then we get to a married taxpayer. If they're covered by a retirement plan at work, then if they make less than 109, they can deduct their IRA contribution. If they make more than 129, it's not deductible. So these are scenarios we got to talk to you about if you're unsure whether it's going to be deductible or not. And then there's also limitations, and this is where all these rules get really screwy, is there's also a limitation if I'm a married taxpayer with a spouse covered by a retirement plan, but I'm not covered by a retirement plan at work, then I have different income limitations for my IRA contribution and whether it's deductible or not. So pretty weird system, but we can help you navigate that. And then another way to reduce taxes is saving in a health savings plan or health savings account. These are only available if you have a HSA eligible, high deductible health insurance plan, either for yourself or family. And you can put in these amounts, single $3,650, family max $7,300, and then you can put in a little more if you're 55 or older. So these plans, you putting money in, lowers your taxable income and lowers the amount of tax you have to pay in that year. Now, we really kind of, bang the table on HSAs. If they work for you in your health insurance plan, then the benefit of an HSA is huge. It's triple tax-free. It reduces taxable income today. It grows tax-free inside the account. And once you get a certain amount in the account, you can invest it for growth. And it can be withdrawn tax-free if used for medical expenses. So huge benefits there for an HSA. I wish you could put more money in them. But we have our limitations. We don't have any income limitations on them. So really a great source of savings. You can either use it now or save for retirement medical expenses, which is a great way to use them. Again, here's like the example of putting money in but growing it for retirement and really saying, I'm not going to use it all up today if I don't have to, and I'm going to max it out. And I don't need it all today, but I know I'm going to need it at some point in the future to pay for medical expenses when I'm retired. Great way to build up another fund for retirement. Through your employers, you might have flex spending accounts. So you might have a medical flex spending account that has to be used for medical expenses. Now, this is different than a health savings account. A health savings account, you can roll over from year to year, and it's your money, you keep it. A medical flex spending account usually has lower limits, and it's kind of a use it or lose it scenario. So you got to make sure you're only putting in enough to use up in the year. And then dependent care, if you're paying for daycare, which I don't have any kids in daycare anymore, but when I did, it was way more than $5,000 a year. So you would know that you're going to spend at least $5,000. So you can put money from your paycheck into a dependent care account. $5,000 reduces your taxable income, saves you maybe $1,000, $1,200 in taxes, and then you can use that $5,000 to pay your care provider or reimburse yourself if you pay it directly yourself. Now, we talked about charity before, so here's where we get into the strategy of what I call bunching donations, because we saw in that tax example, that person was giving to charity, but because they were standard deduction, they weren't itemizing, they really weren't getting a benefit for that. So the strategy on a charity contribution, if you don't itemize or don't have other additional stuff to add up to enough to itemize and add your charity to that, the strategy would be to bunch up your donations into 1 year. So if you give $5,000 a year to a charity and you're not able to deduct that $5,000 every year because you are under that standard deduction limitation. Well, one strategy would be is give 0 in year 1, 0 in year 2, and $15,000 in year 3. So in one tax year, you have given $15,000 and you're able to deduct it. Just one strategy to use. Once you're age 72 or older, there's also something called a qualified charitable donation from your IRA account. So we can talk about that. Actually, I just said 72. I was wrong, 70 and a half. You can do the qualified charitable deduction contribution, which essentially is you're giving your charity directly from your IRA, and it goes directly to the charity. You don't get the money, so you don't get taxed on it. They still send out a 1099, so on your taxes you have to say, I didn't take this money, I gave it to charity, but then you don't pay tax on those dollars. So that's a great way of giving to charity once you're age 70 and a half or older and have an IRA account. Another thing that we do within your accounts, just as part of our management, is offsetting gains with losses. So this year we do have losses in accounts. And this counts for non-retirement accounts, so your regular brokerage accounts. We will, if we have a loss, potentially we would use that loss and then buy something else to offset a gain in another investment. So from a tax perspective, we can wash out the gains with a loss and reduce the taxes that you would pay through your 1099, through the capital gains. So that's something we do automatically through our management of the non-retirement accounts. So just in summary, reducing your taxes, save pre-tax in 401k or deductible IRA, save in your HSA, save in flex spending accounts, donate to charity, potentially if you can deduct on your itemized deductions, and then tax loss harvesting, offsetting gains with losses in taxable accounts. So you know where to find us. If you have any questions, please email us. Go to our website. You can set up meetings that way. Give us a call. We are always available to chat about any strategies or any questions that you may have. Thanks, everyone. Have a great day.